Welcome, everyone. It's Angelo Robles, and welcome to Family Office TV and, for my members, SFO Continuity. It's great to be back live, literally live, here in the summer. As many of you know, no time off for me this summer. I've been incredibly active with both in-person and digital programming. Today, we have actually a return guest, and we're going to get to that shortly. Because if you go back to February of 2023, where I interviewed our special guest today, we actually did drop some names on you in the public AI arena that, if y'all listened, would have done very, very well. But we'll get to some of that shortly. Very simply, the title of our session today is How to Make Money Investing in AI. It features the return of Dr. Craig Kaplan, CEO, IQ Company. And although it sounds a little like it makes it feel too old, Craig, but I do use the verbiage retired hedge fund manager. I don't know if a hedge fund manager is ever really purely retired. But on that note, I think it's important to give some context of Craig's background, and then we're going to jump right into it. When it comes to investing successfully in AI, it helps to have AI experience as well as experience in the stock market. Fortunately, our guest on the podcast, as noted, Dr. Craig Kaplan, has both. He also, as I noted, ran a hedge fund for a number of years. Since 2021, Craig has realized significant returns on his personal AI investments, trading only large cap public companies. Without providing investment advice, Craig will share how he evaluates AI investments, how he thinks about investing in the space, and he will share his thoughts on the future direction of AI and what it means not only for investors, but really for the future of humanity. So it's hard to go anywhere in today's world, especially in the world of investing in family offices, and not hear the tremendous buzz and the reality. Look at the Magnificent Seven. Look at that incredible rise of NVIDIA. AI is effectively everywhere. And having a special guest on that I'm really cutting through a lot of noise for many of you. Many of you know that I do interviews on private companies in AI and humanoid robots, and those are awesome. I love that. But this is something that really, I think we all could understand, and we all could do our own research, form our own thesis, make our decisions on, and actively allocate, whether family office or not, in effectively the arena of AI, which, if you're invested in any sort of broad market index, the triple Q, the S&P 500, given the significance of organizations at the top that have become heavily not only big tech, but AI centric, you are getting some exposure now. So first of all, welcome back, Craig.
Angelo, thank you for having me back on the podcast. Great to be here.
It's a pleasure to be on. And yes, we will be dropping some names today as some of the public companies as we build up a little bit of a foundational information and set the foundation for the discussion. And this will only be applicable to those of you that are live today. But at 5:30 Eastern today, I'm doing a private 20-minute session on a private Zoom with Craig for my members, where we're going to really go over in a short amount of time probably 10 or 15 different public AI companies and really get a approximation, his perspective, meaning Craig, of opportunities broadly in the market and in those companies. Here's what I'm going to do. If you're watching this now and send me a DM or an email, and I can't guarantee I could get to everyone, we're probably going to wrap this up in about an hour. But if you're able to do so, I'll allow 3 people to come on as a special guest live to that private Zoom. You probably have to send me a DM in LinkedIn or an email to angelo@angelorobles.com, and you will get some of the same insight that my members are getting. Craig, on that note, let's get right to it. Effectively, what is AI and how has it changed? It's the key part over the years.
Okay. I mean, AI is my favorite subject. I've been in this field since the mid-1980s. and actually did my graduate work with one of the Nobel Prize winners who co-founded the entire field. The field was named in 1956 at a conference in Dartmouth, and that was sort of the birth of the term of artificial intelligence. So AI, one way to think of it is it's machine intelligence. So machines that can do anything that humans consider intelligent. That's one of the definitions that's used that's fairly broad. And in terms of a quick overview of sort of how this field has evolved and the type of AI that we're seeing now, in the early days from like 1956 to 1980, it was all sort of expert systems. You programmed in specific rules, if this, then that, and you had computer systems that could sort of function in very narrow domains. And then in the 80s, you began to get the beginnings of what is now modern AI. It's really a subfield of AI called machine learning. Some people call it deep learning. And it's the idea that instead of teaching and programming into the AI specific rules of how to behave, instead you give a lot of data to some algorithms and you allow the computer program to actually learn patterns in the data. And then even though you don't know exactly how the computer is representing information and exactly what it's going to do, it is learning concepts in its own way, sort of like a black box. And then you end up with something like GPT or ChatGPT, where you can put in information, prompt, and it will give you information back. And it sounds pretty intelligent, kind of sort of at the average human level. And of course, there's problems. It hallucinates and it makes things up, and it's far from perfect. But that type of modern AI that we have now, really the foundations were laid in the 1980s when I was doing my graduate work, and it's just gotten better and better. The reason that it sort of exploded really in the last few years is simply the increase in computing power. So that's what's driven it. We had self-driving cars in the 1980s, but they could only go, a few feet per hour. And now if you just replace those computers that were in the van in 1980 that could process information as fast as it could, and you could go a couple feet an hour, if you just put in modern computers, you'd be at 186 miles per hour. So simply the computing power speed up is the number one factor of why we all of a sudden, kind of crossed a tipping point, and now these systems are impressing everybody. And I think you were early on this. ChatGPT was released, sort of came into everyone's consciousness in November of 2022. And I think in early February is when we did our interview. So congrats to you for being right on, right an early adopter and an early.
Well, my audience knows that I sometimes jump into things and exponential technologies and opportunities probably too quickly. I'm eventually right, just that sometimes my timeline could be a little off. But you did mention it. I mentioned it. Many of you know that I like to do long form, 2 hour plus, deeply educational, I hope, intellectual interviews. There is a time and a place for that. And although it's a year and a half old, February of 2023, the before interview mentioned is up on my platform. If you go to Google and put in Angelo Robles interviews Dr. Craig Kaplan, it should pull up. If you go to my Family Office TV or at Family Office, either one, I have two on YouTube, you'll find it from February of 2023. And we go real deep into the original origins of AI, Ada Lovelace in the 1800s. And that is a little bit more of my typical, the impact on political, geopolitical, and broadly investing in family offices. This is far more targeted from an investing perspective, which we're starting to get into kind of right now. Craig, what is the market opportunity in AI for investors?
So I saw recently IBM has their annual Think conference, so Think 2024. And the CEO there, Arvind, basically said he thinks it's a $4.4 trillion market opportunity. I've heard estimates higher than that. I haven't heard too many estimates lower than that. It's really a very unique technology, extremely powerful, that has the potential for transforming, pretty much every industry. And the reason is it's really inventing a new form of intelligence, right? So everything that humans do, every industry, no matter whether you're a lawyer or you're in human resources or insurance, or you're building widgets or you're doing some sort of service, It all depends on intelligence. In the past, that intelligence had to come from humans. Now we're on the brink of beginning to be able to automate and scale that intelligence and have it come from machines at a human level, which is unprecedented in all of human history. So to me, even though I've been in this field for over 30 years, I still get very excited about it. I don't think humankind has ever seen a technology as disruptive as this. And so huge market opportunity. And from an investing point of view, the key is trying to understand what the key drivers are so that you can sort of evaluate investment opportunities intelligently.
And I think the $4.4 trillion estimate is shamefully low. You look at the rise of NVIDIA, you look at the companies that make up the Magnificent Seven, you look at the future of companies that are private going public, and the impact that AI is going to have in this community and how it's changing so quickly. I believe Elon, a guy that only needs a first name commentary on humanoid robotics, an aspect of AI, is thinking 24 trillion, the impact in healthcare, in manufacturing, in construction, etc. I think, and not decades out, but relatively in the sooner rather than later, I think we're easily looking at tens and tens of trillions of dollars, including companies that are the largest companies in the world now, which we'll get to very shortly, basically stating, look at what their market cap could be in 2 years, 5 years, and 10 years. It's probably going to dwarf what it is now. But as we build into a little bit of that investment aspect of the dialogue, you have people like the current CEO of Google, Sundar, basically noting that he believes that AI will be more impactful than water. No, I'm sorry, water. It's hard to be more impactful than water, but fire and electricity, which is also a little bit unbelievable. You have Elon saying things like 800x more powerful in a short couple of years. And those of you that want to go back to my YouTube platform more recently, about 3 weeks ago, I had on Ray Kurzweil and Dr. Harry Kloor. And they're very optimistic. Ray Kurzweil obviously is involved in Alphabet and Google as kind of their futurist. So these are all things that are building towards something that is just not going to disappear. Now, we'll get into bubbles and things like that. But I suppose my next question is going to be, can individual investors hope to compete with large funds that have much more resources, analysts, and data about AI companies?
So this is a great question. As you mentioned, I ran a hedge fund for a number of years and also ran a data company that provided signals and data information. Our clients were sort of the very largest quant funds. So I have a very kind of insider view of how they operate. And as a result of that, I also was on the trading desk for 14 years. So I'd get up at 4:30 every morning, and I've probably personally placed billions of dollars worth of US equity trades over that period because we were tens of millions of dollars in and out of the market every single day. And what I learned was that an individual investor has strengths and weaknesses with respect to the larger guys. And it's very important to understand sort of who you're competing with and where you might have an edge. So the good news is that an individual actually does have an edge compared to those large funds. And I'll explain what that is. But you also need to understand where you don't have an edge. So let's start with the bad news, where you don't have an edge. And that's pretty much what you alluded to, Angelo. The large funds, I mean, these guys purchase every data set that's available. They have real-time data feeds. They spend tens of millions of dollars on this. They have buildings that are filled with sophisticated computers that go from the floor to the ceiling. The power required to run these things, quant funds, is the equivalent of an entire PG&E power substation. So you're not going to sort of beat them by listening to CNBC or an investment newsletter or even what we say and trying to short-term trade and expect to beat these guys. They simply are faster, smarter, have way more data than you do. And it's just an extremely difficult game. And I speak from experience, having been the guy that tried to do that, tried to beat them every day for 14 years. And the only way you can do it is if you have some unique source of data or some unique edge that might be very expensive, like my company did to build. On the other hand, an individual actually does have certain advantages. And so The ones that I see, first of all, is time frame. So any large asset manager has to report quarterly results. That means they really can't, they say they are in it for the long run, but they really can't be, because they're forced to not have too big a loss on any given quarter. That's a tremendous advantage for the individual investor who has a long time horizon and a little bit of patience. Because if you're willing to say, I'm going to make this investment and it may go up, it may go down, that's okay. I've sized the position small enough that I'm comfortable. I can lose 40% and I'm still not going to panic, but I've carefully thought through my thesis and I'm confident about this. Over a 3-year time frame, I'm going to make money. You can afford to ride out things that the big guys, despite all their extra brains and data and everything, they simply can't. The people who give them money will be very upset with them if they have a down quarter. And you can afford to sort of stay in the game longer than they do. So that's actually an advantage. You can make that work to your favor if you're willing to take a long time horizon. So that's the primary advantage. And I think the other one really is not trying to do everything, but trying to specialize in something that you know, or you feel like you can analyze it a little bit better. So in my case, that's why we're having this podcast. It's AI, right? I have 30 years of AI experience and I've got the hedge fund experience. So the intersection of those two things is investing in AI stocks and being able to see things that maybe the Wall Street guys don't quite see. Almost all of Wall Street professional funds, they are using historical data and they're expecting, even if they don't say this, they're expecting the future to be sort of like the past. But when you have something disruptive like AI, the future is not necessarily like the past. This is something new that hasn't happened before. And if you actually understand the field, you can begin to see how it likely will play out, whereas the other guys are sort of reacting. And so that can be a big advantage. So to summarize, being patient and willing to take a longer time frame is a huge advantage. And being willing to sort of specialize and focus in an area where maybe you have a different view, whereas they're looking at the past, you can sort of look towards the future. That can also be an advantage.
Well, you gave me a lot to chew on there, Craig. My next question was going to be one effectively that you answered in terms of the advantages and disadvantages of an individual investor, or more sophisticated, broadly, a family office compared to a large, let's go with the word hedge fund manager. I don't know about you, but given that you're formerly one, given that one of my headquarters is effectively based in Greenwich, Connecticut, hopefully I have a little bit of experience with the verbiage hedge fund manager. And back in my day at Family Office Association, the biggest figures in the community, Ray Dalio, Steve Cohen, Tudor Jones, David Einhorn, Bill Ackman, and so many others. I've been so fortunate to have speak, and some of them me interview at my programs. So with all respect to their intelligence and their capability, and they're all East Coast and a little more on the conservative side, a little bit away from Silicon Valley, but I go to their 13Fs and I kind of know a little after the fact, for the most part, what they're doing. A lot of them are in NVIDIA and the Magnificent Seven. They may or may not, their call, be using leverage. And again, families in theory could quote unquote do that too. But I really wonder about the so-called edge of the hedge fund manager. Now, I know I'm potentially trending a pinched off topic, but I'm going to bring it back in. I want to give additional confidence to the ability, the capability, the talents of the family office, knowing that although there's incredibly talented structures out there, like certain hedge funds and GP structures, the vast majority, Craig, I'm just looking at the math, no disrespect to your old industry, net of fees over time, VC and hedge funds are going to often lose to the triple Q. They're just not going to beat it, specifically net of fees. Over a 10-year period, it depends on what you look at. About 6 to 8% of them will, but that's single digits. That's a little sad. Why?
Well, okay. So at the risk of alienating my former colleagues in this field,
I know.
but you have the same problem.
They're not going to talk to me now when I go into La Scala in Greenwich.
But I think the way that maybe we're both seeing it, a key thing is alignment of interest. So one of the advantages that a family office has if it's managing its own portfolio, or an individual investor, is you're not really worried about, if it's 2 and 20, you're not worried about that 2% fee that you're getting on assets. The problem with that is that that's an incentive to simply acquire assets. And you really want to sort of, if you can just stay close to the index and performance and just get more and more assets, become an asset gatherer, there's a lot of firms out there that simply are content to do that. And yes, maybe they have a performance fee and that's a kicker, but they're always going to get that 2%. Well, a family office or an individual, we don't get 2%. We have to actually outperform to really do it. So it's a little bit of a different incentive, as opposed to the incentive being gathering assets. The incentive is really what is known in the industry as alpha. Can you have some sort of signal or outperformance above a benchmark like the S&P 500? You're absolutely correct. I don't know what the current stat is, but at one time it was, just buying an index like that, like the SPY or Qs, is going to outperform 80% of all the professional money managers. And it's very difficult, even for the ones that do beat that benchmark, for them to maintain that over time. There's a few.
And net of often a 2 and 20 fee structure.
And then you add fees on it, it's even harder, right? So
right. That's why it goes into single digits.
That's right. So I think another advantage, back to the advantages of individual investor, is that you don't necessarily have to pay those fees. You don't have those same objectives. Your objective is purely to try to generate return. You're also able, depending on your risk tolerance, to have higher concentration. So most hedge funds or large asset managers, they won't have a position that's larger than 10% in any one name, which is prudent, by the way. Excellent. But if you're an individual and you're willing to take that risk, you can do it, but they can't. Even if they wanted to, if they really wanted to put more than 10% in NVIDIA, they can't, because they're going to have to constantly trim that position just to stay within the parameters that they sort of represent it to their investors.
I mean, wow, you basically said a lot there. And we don't mean to kick the industry. Again, it's...
No, I mean, a lot. And there are some excellent ones. Renaissance does outperform consistently. I mean, there's a few stars that, hats off. They're simply brilliant, right? So you don't want to take anything away from them.
But it is relatively few. And you do bring up a good point. As they become asset gatherers, they're more likely to want to placate to institutions. Institutions are usually more conservative. They usually don't want more wild swings. So if you're able to get a little bit more of a consistent return and not go down as much in the bad years, which do happen, as much as being long only, you start to placate to that community. You're getting your 2 and 20, you got a couple of billion or tens of billion, and also smaller opportunities become harder to move the needle. But then as an investor in a family office, not only do I not have control over what the hedge fund manager is doing, I may also have a variation of lockups. I don't have complete liquidity, versus if I'm doing this all internal, I have complete control. Now, yes, am I an extreme advocate of the single family office? That single family offices absolutely need to get better, but they are the most incredible vehicle in the world for the super rich for some of the reasons that we're speaking about today.
You alluded, let me jump in, because you alluded the family office or individual investor has. And this is more of a tactical thing, but a large fund, if you have billions of dollars to put to work, you are going to move the market. So let's say I wanted to get in NVIDIA or especially a smaller name, right? If I have a lot of money to get my position, if I want a 1%, I have to do that over time. The more money I try to move in a short time frame, I'm going to push that price, okay? If I'm an individual, I never have to worry. Well, for me, I don't have $1 billion to put in. And so I don't have to worry about pushing the price. If I wake up in the morning and there was some news that tells me something that says this is the stock that's going to move, I can take my entire position within a minute or two, and I'm not going to move the price much at all. Similarly, if something happens, if God forbid one of the CEOs dies or something, and that's going to affect the stock price, those large guys are going to have to get out of their position slowly over weeks or months to avoid sort of tanking their position. A small person can get out right away. So the ability to get in quickly, get out quickly, you have a tactical advantage there as well, which you alluded to.
Do you have a specific investment thesis about AI?
Yes. Okay. So this is where, so I want to preface this with, this is not investment advice, right? Entertainment purposes only. I'm sharing my personal view on it. And just because, as you know, I don't know who listens to this, there's a range of people with investing expertise. You have to be very careful, especially if you don't have a lot of experience in the market. You can lose all your money. So just saying that as a broad disclaimer. That said, the way I personally look at it, for AI in particular, it's a very simple thesis. I have 30 plus years experience, and I understand when I see what NVIDIA is doing, and I see what Google's doing and what Meta's doing, and I go to the AI conferences. I speak at the AI conferences. In June, I was just chairing a session on artificial general intelligence, and I presented there. I'm presenting at a conference on AGI in Seattle. I'm out there actively because I do research in the field to have a finger of the pulse on what the current state is. And the simple thing that I see, it was definitely true during our first interview in February of 2023. I believe it is still true now, is Wall Street simply has not priced in the speed at which this technology is going to develop. It's constantly catching people by surprise. So most of the professional money managers and investment advisors are continually playing catch up. I mean, you can see it even if you watch CNBC or something. The talking heads come on, and it's just a continual game of they have a price target for NVIDIA, and every month or two they have to raise it, because if they don't raise it, they're hopelessly below what the stock has already done. And why is that? That's because this thing is moving much faster than they would have thought. Why is it moving faster than they would have thought? These are not unintelligent people. These are professionals that devote every working hour to trying to figure this out. But because they're not experts in AI, because it's a new technology, they look at historical trends. If you looked at historical trends, you would never anticipate that NVIDIA would grow as fast as it did, or that Meta would grow as fast, because it's not in the data, right? And so no matter how brilliant these guys are, and they are super brilliant, they will take 20 years worth of past stock market data, put it into their algorithm, back test it, and come up with a range of cases. And based on that, they will make their bets. But the past is the rear view mirror. And this is a new kind of technology. So my thesis, very, very simply, is this: AI is moving faster than Wall Street is priced in. And the reason that that is true is that Wall Street is using historical data. I know that's what they do because I was a hedge fund manager and I also sold to these guys for 14 years. And I know that's what they do. That's what we did. You use historical data. That's the best you can do. It's impossible to be an expert in every area. And so there's a heavy reliance on what history has been. But this is disruptive. So it's not going to be in the history. So if you are an expert, or if you really understand that this thing's going to move faster than people think, it's not hard to make money. And that's back to our interview in February of 2023. I mean, we listed the names. If you just listen to that interview, if you had bought any of those names, you would have outperformed the S&P by multiples, right? And the whole reason that that happened was because those names moved much faster than history would suggest. And history, everybody's anchored. All the professionals are anchored to history, really.
I mean, you kind of answered it, but how do you evaluate AI companies for potential investments? Again, specifically public companies.
Okay, so there's this general thesis that AI industry as a whole is going to move faster than most people have priced in. Now they're catching up. So that's not going to be true forever, because eventually, after 3 years of sort of beating expectations by huge amounts, people adapt and they say, okay, maybe I was too conservative and I got to give more weight to recent history than the last 20 years. I should look at the last 2 years. So that's going to go away. But right now, that's still in play. That's a separate thing. That's a simple thesis that sort of says why the field as a whole has a tremendous opportunity, in my view, and for me personally, to make money. And it's a once in a lifetime kind of thing when you have this shift. But in order to sort of be more precise and not just say invest in AI generally, but sort of which AI companies and why, then you need to understand a few simple things about AI. And if it's okay, and you tell me if I go too long on this, but I would like to take. It's one thing to name specific names in video or whatever, but it's much more valuable, in my view, to actually explain how to think about it. Because if you know how to think about it, then It may be not be NVIDIA, it may be something else, but you'll have the mindset to help you evaluate. So that's what I would like to share with your audience.
That's the most valuable thing that anyone could do. Learn effectively the process and consistency to think for themselves. On this specific niche, please do share.
Okay. So without saying that you need to be an AI expert, there's 3 key things that are driving AI and will probably drive it for at least the next 5-10 years. Okay, one of them is that these are computer systems and they use computer power, computational power. So computation, or compute as it's called, is a key element. It's one of the pillars of modern AI. And what that means is that the chip makers like NVIDIA, AMD, and the people who design, who fabricate the chips like TSMC, and the people who make the tools that the fabricators use like ASML, all these guys are sort of, going to probably do well in general, that sector, because there is an insatiable demand for more and more computational power. And the reason NVIDIA is doing so well, to pick an example, is because they have the best chips for doing machine learning, which is what all the AI systems are using right now. And they're the best. And what best means is not only fastest, but also most cost effective. They give you the most compute for the least amount of money. And they're just ahead of everybody. So they may not stay ahead of everybody, but understanding that computational power is one of the pillars that all of AI rests on is important. Okay, there's 2 other pillars. The second pillar is algorithms. So you have these computers, but they have to run a computer program to train the AI. And those programs that train it, those algorithms, are a key factor. So if you had a better algorithm than somebody else, if yours was 10 times faster, then with 1/10 of the computing power, you could get the same result. Or with the same computing power, you could have an AI that was 10 times smarter, right? So algorithms obviously are an important thing. It's a little harder to quantify. With computing power, it's really pretty simple. You say, who has the best chips? Who is everybody buying? And you just kind of do some estimating on, when is everybody going to be satiated, which is not anytime soon. So that's easy. Compute. And it's the easiest thing for all these companies that are trying to develop better large language models and better versions of AI. The easiest lever for them to pull is, let's throw more computing chips at it. We know if we put more computing chips, we'll get a better AI. That's using the same algorithms. A little more tricky is, what if I could come up with a better algorithm? Well, it's hard to predict those breakthroughs. So that one, in my mind, sort of reduces down into the question of who has the best talent, right? So Google, for example, there's DeepMind. Demis Hassabis, who runs DeepMind, is a brilliant AI guy, and they have some excellent AI talent. So if you can evaluate the people that are on the teams, and this takes a little more work because you sort of need to know a little bit about the state of the research and everything to figure out who really is great and who isn't so good. But in general, companies that have a reputation for attracting really good AI talent, that will eventually result in, one would think, better algorithms. If you get better algorithms, you're going to get a better AI with the same amount of compute power. So the first 2 pillars are the compute power, the chips, and there's a whole bunch of companies that are associated with that. The second pillar is going to be the algorithms, and that's really AI talent. Who has the AI talent? Then the third pillar, and this one is going to become increasingly important. We talked a little bit about it way back in February. It hasn't changed. It's just that the easy thing to do is throw more compute power. So everybody does that first. And of course, you try to get the best people you can. And then eventually, the bottleneck becomes data, because all of these AI programs are trained. So you have the computing power with the chips, and you have the algorithm that runs on top of the chips that will learn. And then you have the data. The data is what trains the AI. And so in the early days, it was shovel the entire internet at it. I mean, filtered a little bit, but it was like 3 Library of Congress's worth of information. And we just take all this data and we just imagine just shoveling it in and then waiting, letting the compute power go as fast as it can with the algorithms to train the AI, and out comes ChatGPT, right? That's how they were doing it. And if you've ever interacted with ChatGPT or any of these large language models, you realize that they kind of, can cover really broadly lots of topics. That's because the entire internet has been sort of shoveled in there, lots and lots of data. But you also may realize that they're not super smart about any one topic. Like Angelo is an expert in certain fields, and ChatGPT is going to be nowhere close to Angelo in those areas where he has specialized knowledge. Same with me, same with pretty much everyone in the audience. If you have specialized knowledge in a particular area, you're going to get kind of mediocre feedback from ChatGPT in your area. It may be really fast. It may be very glib. It can produce things. Sometimes it makes mistakes, but it's because you're basically getting the mediocre internet. All that data was used to train it. So what happens next? You can ask yourself, what happens next is if you want to make the next better AI, you can throw more computing power at it. That would be NVIDIA and all those things. You can get better talent to make it better. That would be whoever's best at recruiting the talent. But the third thing would be who has the data, who has the high quality data, not the generic everybody kind of data, but who has like the experts, like the guys on LinkedIn, which Microsoft has, for example, or, Google has a ton of data. Meta has a ton of data. Whoever has the most data, that data is going to become more and more valuable in order to get that next level of intelligence. Okay, so that's the third pillar. You've got the computer chips, you've got the algorithms or the people, and then you've got the data. So you can almost, with those very broad strokes, you can then look at who's out there publicly traded, and you can ask yourself, how do they do on these three dimensions? Somebody like NVIDIA, you're going to say, my gosh, there's nobody who has better compute than them. And everybody's going to do that first because that's the easiest lever to pull. That's why they're taking off. But you can also look at somebody like Meta or Google, and you can say, my goodness, look at how much data those guys have. Someday, that data is going to become like gold because everybody's going to have trained it on the readily available data that's easy and public. And now it's going to be who has proprietary data or is able to, out of all the people that Google accesses or that Meta accesses, some of those people are experts in different area. Are they able to, effectively filter that data and use it to train? And if so, their AI is going to be better, right? And so you can see that there will come a time when data will be king. Starts out chips are king, people, and then it's going to be data. So you can see that pattern, and then you can just translate and say, well, which company should I buy? Again, because my particular approach is not to trade in and out. I'm not going to sell NVIDIA if it goes down 20%, and I'm not going to buy it and sell it, on a daily, weekly, or monthly basis. I'm talking about a 3 to 5 year time horizon because it's going to take multiple years for this to play out. But if you see that that's the path, then you can make those purchases now and you can wait. And you've got the advantage over all those hedge funds who have to be evaluated quarterly because it's very hard to know the timing. You could be off by a year or two. And if you're a big hedge fund, it's too late. You have to sell the position because it didn't go the way you thought it would. But if you're an individual or family office, you can afford to be patient. And if you have confidence in that thesis, you can make, I think, a lot of money without that being investment advice. That's my personal view.
That was a fantastic response to that question. Thank you so much for sharing with my audience and my members. Can you provide some examples of past AI investments and why you made them?
So sure. I mean, and this might be a little bit repetitive with what we just said, but if we go back to February of 2023, I think you mentioned, how about Microsoft? So Microsoft, yes, I said Microsoft is good. I also said you should look at NVIDIA for the chips. You should look at Meta for the data. So let's take those three just as examples. Companies, but they sort of are illustrative of, NVIDIA is illustrative of a company that's very, very good on the hardware and the compute. Now they have a lot of other things, and that CEO is amazing. And if you want to see how far ahead of the curve, then I would recommend reading the annual reports from 10 years ago. Just start 10 years ago and go up before anyone was talking about AI. And you'll see Jensen Huang was talking about it. So, I personally love a visionary CEO that sticks to his guns, and, that's what you got with Jensen. He's amazing. But they initially have a huge advantage in the chips, and now they're expanding out. And in that particular case, what I like also is he's just forward looking. He doesn't rest on his laurels, right? So a lot of companies, they maybe got lucky or something. That's not the case with Jensen. He planned it way in advance, but there was a little bit of timing where the timing was great. ChatGPT took off and he was ready and he accelerated. Now he could have said, okay, we're going to just sell to Google and Meta and everybody. And eventually, those markets will be saturated, but he hasn't stopped. He's now going to countries. I mean, as fast as those individual large, if you ask yourself, where's my next biggest market? Put yourself in his shoes. Where's my next biggest market? I've sold to Google and Meta and Amazon and all the big tech companies. Who's bigger than them?
Governments.
Saudi Arabia. How about the United States? How about, let's sell to an entire country. How about Singapore? And basically make the case, which he has done. You can go see, it's all public. I mean, he speaks at these different conferences. He's basically making the case to Singapore or whatever country that the most valuable asset that you, Singapore or whatever country, have is your data. And you want your AI to be trained on your proprietary data. And so in order to do that, you got to buy our supercomputers with all our GPUs, and you got to do it now so you don't lose the race. I mean, that's basically his pitch. And now you've got entire countries that are competing with each other and lining up, and they cannot sell those things fast enough. I mean, I just look at that as a former CEO for 30 years and say, wow, that guy is really, really good. And so that's an example.
So if you don't mind me pressing a little bit, that's a very rosy and optimistic outlook, which is great. That's wonderful. To double my money, and let's even use NVIDIA, over, say, 5 years, I need to get, I think it's about 14.4% return. So it's all relative. Like when I say double 10x, the really key question is, what's your timeline? Because that really helps to determine everything. But to double effectively means that market cap, which is already trillions and trillions, is effectively going to have to double. I know people are going to look at that and say, just how? But if we look back, pre-COVID, 10 years ago, 15 years ago, we were probably saying the same things about the largest three companies then. Therefore, do you think, and I think you do from what you said, mainly in my last question, that the mechanics are in place for it to do well? Maybe in the short term, there could be some hits, but do well, let's call it over the next 5 years.
Yes, I think 3 to 5 years, I'm very confident that those companies that are sort of hitting those three key pillars will do well. If you have an edge in compute, if you have an edge in data, if you have an edge in AI talent, an edge in any one of those things, you should do very well over the next 3 to 5 years, which is about as far as I can see. But amazingly, I think it's much farther than most of Wall Street is looking, based on sort of their price targets and everything else. So you have to have, again, you have to have the risk tolerance. It's very hard. This is something I learned, not exactly related to AI, but just to investing in general. We had many people put capital into our fund, and I'd say, well, this particular strategy that you're in, it could go down 20%, and that's not unusual. And they say, oh yeah, that's fine. But it'd go down 10% or 15, you start getting the phone calls. And at 20, it turns out that they may have in good faith believed that they could tolerate that. But it's one thing thinking that you can tolerate a drawdown. It's another thing experiencing it. And that's very important. It comes down to sizing your position. As long as you don't size your position too large and you're willing to lose it, or you're willing to really, lose a substantial portion of it, then you know that you have the right size to go for a long time frame. If you're saying, or if the actual reality is it goes down 20, 30% and you're bailing out of the position, then you really shouldn't be in that position for the type of investing that I'm talking about, because this is over a long time frame and you have to be willing to tolerate those moves. These are very volatile companies. If you can't tolerate it, then you have lost your big advantage. Now you're just like the hedge funds, only the hedge funds have bigger data, more data, and more computing power than you do. So you have no chance. So you're giving up your edge. So make sure you size your position so that you have the patience and the ability and the stomach to actually go up and down. And then absolutely, I think you could double your money in 5 years. I don't see a problem with that. That's probably conservative.
Excellent answer and advice. The couple of companies that you did mention, NVIDIA with Jensen, Meta would of course suck, and Microsoft with a great CEO. Those three companies, I think, have one thing in common that I think we'll agree with. And I just hinted at it. They have incredible CEOs. In two of the three cases, as founders, how important is it in this AI race and investing broadly in big tech and AI? I guess it's pretty obvious, but that you have a wonderful leader that knows the technology, is a leader, develops culture, and knows that now is the time to grasp the opportunity. Those three companies have great CEOs in common. I would think you would agree.
Yes, I agree. And I think it's very important. And it sort of gets probably to that pillar about the algorithms and the talent. You know, if you put those two together, algorithms/talent, the talent comes up with the algorithms, the management talent hires the researchers that come up with the algorithms. So if you have really good management talent, that's going to help a lot in this game for sure. Very important. And I have a bias. This may be because I've been a serial entrepreneur myself, but you know, there's something special about having a founder that's also the CEO. First of all, it's really hard to do, to scale. So to be a founder-led company at this, you know, at the size of Meta is extremely rare. And so there's a selection thing. You have to, you know, he's not just the ordinary founder that sort of came up with the idea but didn't know how to scale the business. He also knows how to scale the business. So that's a rare combination. And that founder typically has the same advantage in a way that an individual investor or a family office has, which is, in the case of Meta, you have Mark Zuckerberg, who controls voting rights, right? His shares vote 10 times as much as the rest of us. So he actually controls that company. So, I mean, he plays nice with Wall Street and everything, but if he really feels something is right, he has the ability to act on that. Whereas sometimes if you're not a founder and you don't have control over the company, you know, when push comes to shove and you get to that decision, you may end up having to compromise and do something, even if you don't think it's the right thing, just to keep your job or to appease Wall Street or their shareholders. So there's an advantage that those founders have, which is they're not as beholden to the other people. It's the same advantage that an individual investor or a family office has. You're not beholden to every quarter you have to show a profit or whatever. If you've agreed amongst yourselves that it's okay, we're going to make a long-term bet, and we're really aware that it may go up and down, and everyone's on board with that, you can do it. Whereas you just have fewer constraints. So that's another advantage they have besides just being really smart, brilliant people.
Indeed. And again, I did want to mention some company names, which we did: NVIDIA, Microsoft, and Meta. And in the private session upcoming shortly that we're going to do in a private session on Zoom, we'll dive into about 7 or 8 other companies and maybe a couple of off the radar surprises, all public. So these are not private companies. So really anyone effectively could invest, should you decide that's part of your diligence that you do and your thesis and the decisions that you make. We always hear about a bubble, and inevitably a broken clock is going to be right twice a day. I'm assuming there will be a bubble. The market will go down. I don't know when, I don't know how long, and necessarily what are going to be the driving factors behind that. I could also look at it, depending on those driving factors, that may be an incredible opportunity to buy more. What's your opinion, again, now putting on the trading hat, which is always risky, of the fact that we're really near a bubble and I'm going to invest now and it's going to go down?
So I guess I just go back to that point. You need to size your position such that if you bought today and it dropped 40%, you're not going to panic. That's my personal rule for this. That said, I don't think I would agree with the folks that are saying we're in early innings. Again, this is back to my thesis that this field is moving much faster than most people realize. So you think it's a bubble if you think, wow, these things have run up so fast, so quickly, it's got to come down. It's it's the tulip mania, right? But I don't think that's the case. NVIDIA is making real money. I mean, they have 78% profit margins. That's insane. Their revenue is growing really fast. I mean, it's real cash that they're generating. So it's not the same as pets.com or something in the 1999, 2000 bubble area. It's very different. And then for me, coming at it from an AI perspective, I just see there's nothing more powerful than intelligence. I kind of see companies being willing to pay almost any amount in order to have a smarter intelligence where they press a button and they clone it. I mean, just the productivity gains they get from that, the competitive advantage they get from that is huge. It's like unlike most things. So I don't think that most of Wall Street appreciates that. I admit I'm a big fan of this, and maybe I'm biased because I'm so close to it for so many years, but I think we're also seeing it play out. So short answer is I don't think we're close to a bubble, but even if we were, please protect yourself and make sure that you size your position such that you don't get hurt, because it is very volatile. Certainly it's going to be very volatile. There's no question about that.
And I think some of the decision comes down to, I think it's pretty logical, and you effectively hinted at it when you gave your big three a little bit. Is it that hard? Supply and demand to a degree within a market infrastructure. And there simply is a tremendous amount of demand, as now, like you said, it's even going to sovereigns and governments. If you don't mind, a little bit of a personal question on your investing. Some of the companies that we did mention, do you still own those investments?
Yes, I have from a hedge fund perspective where 10% is the limit, I have a much larger concentration in, NVIDIA, Meta, Microsoft, Google. Those are my top 4 holdings. And I'm very concentrated in those. So you can take that as a full disclosure. I'm talking my book when I say those things because I own it. And B, it's also, I'm putting my money where my beliefs are. Again, that's my personal view, and everybody's situation is different. So I would strongly recommend, if somebody is not as seasoned in investing, that they check with other professionals and make sure they have a balanced portfolio and they're trying to do what they want to do. Don't dump all your money in AI and then get upset if it goes down. You need to be careful about it. But for me personally, I'm very concentrated in those things.
I have a question. Effectively, what would you need to see? What would need to happen for you to change your thesis?
So one of the advantages, and I don't know who said this, if it was a Charlie Munger thing or maybe it's the type of thing that Charlie Munger would say, you don't have all your eggs in one basket, right? That's the classic, Charlie would not say that. That's the classic Wall Street professional would say diversify, right? And that's why you have concentration limits, and a lot of funds won't have more than 2% in any one name because they want to spread it out, and that's very good risk management. And risk
right, but then they become beta and they hug indexes and they charge you 220 for that.
Well, that's the flip side of it. So on my end, I am relatively concentrated. I don't have them all in one basket, but I have it in a very small number of baskets. And if you're going to do that strategy, which is dangerous, you have to acknowledge the danger up front, then you better be watching those baskets very, very carefully. So this is to your point of what would you need to see? So I look for things. There's a lot of different risks. If we take a chip company or something, like NVIDIA, doesn't have to be NVIDIA, it could apply to many chip companies. But if you have one where you have a great CEO, and we just talked about how great that CEO is, you have key person risk. If something happens to that person, I don't think anything will, but you have to be aware of that. There's geopolitical risk. There's 2 companies that manufacture almost all of the advanced chips, which is Taiwan Semiconductor and Samsung. And Taiwan TSMC by far does more. So, that's Taiwan. And we all know about China and Taiwan, and China says that, maybe someday there will be an invasion. I mean, there's all kinds of geopolitical risk. So I think that would affect not just NVIDIA, to affect the entire chip industry, but you still have to monitor that. So there's a lot of risks that you need to. Andy Grove wrote that book a long time ago, Only the Paranoid Survive.
Yeah,
that's not a bad mantra for investing, especially if you're concentrated. If you're diversified and you're buying the index, okay, you don't have to watch it every day. You got enough diversification. That's going to take care of a lot of the risk. But if you're concentrated, you better be every day waking up and saying, what could go wrong today? And that's basically what I do, while maintaining the long time horizon, because you need to give yourself that room. And, I haven't seen anything yet that causes me to change my thesis. Those kinds of things, somebody invading Taiwan, a CEO dying, something out of the blue like that could cause me to change my thesis. But right now I'm feeling pretty confident in what I'm doing.
How do you see AI evolving in the future?
Wow. Okay. So future, there's short term, medium term, long term. So let's say the next, 3 years or so, I think it's going to be pretty much what we've been talking about. You're going to have those three pillars. You're going to have more and more, better and better large language models developed, more and more deployment across industry. Eventually, people are going to realize data is the limited resource. And so those companies are going to rise. So that kind of stuff. If you go beyond that, and you now are getting to where you have systems that are smarter than you or I, like a lot smarter, which is where I spend actually most of my time. And that's because I love investing. Obviously, we're having fun talking about this, and I like being able to share things with your audience. But I also am aware that AI is a two-edged sword right now. It holds probably the greatest potential of any technology I've ever seen to not only make profits for people, but also improve the human condition. It really does. But it also holds dangers, because a lot of the systems that are being developed right now, these large language models, the way they're trained, people don't really know how they work. You shovel the data in, you give it more and more computing power, and then you see what comes out. I mean, that's really the strategy. So, and then you try to test in safety after the fact, which is always a bad idea. You should be designing safety in. So I spend most of my time from the AI research end basically trying to come up with designs that are safe, so that it's safe by design. Because someday these systems, and when I say someday, I mean 5 to 10 years out, you're going to have systems smarter than all of us that need to be designed to be safe. And we have a limited window to do that. So that's actually my main mission, and making money is a great way to fund that.
What do you see as the big AI investment opportunities now versus later?
Right now, and for the next year or two, it's hard to beat a company like NVIDIA, because it's about computation. It's the easiest lever. It's the one everybody understands. And these guys are so far ahead, and they have a great CEO and all those reasons we discussed. The next wave after that, you're getting into the people that are deploying it. And again, I think you've got Google, you got Meta, you've got maybe Amazon, IBM, some of these other players as well, that Apple even, that can begin taking those large language models and pushing it out so lots and lots of people can use them and get productivity gains. So they ought to do well. And you also have the companies that, as data becomes more scarce, high quality data becomes more scarce, then you've got people that want to use that data, and that data becomes more valuable. So if you're a company that owns a lot of data and understands AI, then that's a good play, sort of overlapping with the chip thing, but probably the next phase. And in fact, Elon Musk, we mentioned Elon Musk earlier. I have a personal theory. I don't know if it's true. I have not spoken to Elon Musk about this. This is completely my idea, that the reason he bought Twitter was really for the data, because to me, that's how that acquisition makes sense. A lot of people thought, wow, why would you pay all that money and, for this thing that then plummeted in value after? But there's a lot of data that's on Twitter, and that data can be used to train AI. And if he's as smart as he is, I would be very surprised if he doesn't have plans or isn't already using that data to train AI.
Well,
So that's a statement about the importance of data in the future. That's a visionary guy seeing that data is the next step and making an acquisition because of it. In my mind, I don't know if it's true.
Well, of course. And you have his launching, of course, of XAI. And speaking of Elon, I guess we'll throw one other company out there, Tesla. Really fascinating company. The impact of AI, the impact of their robotics arm and Optimus, of a robo-taxi. So it does tie in to the AI picture. Again, I guess putting on the old hedge fund hat. And again, a lot of hedge fund managers, I wouldn't say they lost their shirt, but kind of making very bad decisions on Tesla for a number of years. The pain of going against Elon is very real. How do you look at Tesla as effectively an AI play? Or might your opinion be, it's pretty good, but I just simply think NVIDIA's is better in the short term?
So I would start by saying, I'm not somebody who would short Tesla, because I think that guy is incredibly smart. I do have a very small position in it. And I think right now he is not the leader, but that doesn't mean he's an incredibly smart guy. So it could be, he could switch that. That could change very rapidly. He certainly has the vision. I just think some of the other companies are further ahead right now. And so in terms of my personal investment, I have larger positions in NVIDIA and the other names we mentioned, although I do have a small position in Tesla just because I don't count Elon out. I mean, he's a really, really smart guy and a great engineer and a very visionary thinker. I like his view. I mean, how many people, actually think beyond planet Earth and think about civilization like at that scale? That's impressive to me, I think.
And taking action on it, which is
Yes.
Like utterly amazing. And again, a reminder, at 5:30 Eastern, we'll be doing a private Zoom with Dr. Kaplan, kind of building upon the more educational, foundational hour plus discussion now. That is really for my members. But again, if 3 people reach out to me, preferably an email, angelo@angelorobles.com, and I get it in time, and or a DM on LinkedIn, I should be able to invite you into that quote unquote, that private session, which will be very short, but we'll go over a couple of more companies that are probably a little more off the grid than Microsoft, NVIDIA, and Meta. Although, again, for the reasons that Craig discussed, the thesis on those is very strong as well. There's another aspect to what you noted, and it's probably going to be outside your realm. Let's go with that weird terminology. But it's going to be energy, the energy consumption from what you're describing. If I'm an investor, if I'm a hedge fund manager, I have to be thinking about plays in energy to, I don't know, diversify certain risks, potentially looking at nuclear. Or again, I could state the hell with diversification. Energy is a good play, but I'm going to get simply a better return in NVIDIA or a company. And why make it more complicated than I need to? So I don't know if you want to dive into the energy issue and the impact of the investment arena there with AI, but feel free to jump in if you want.
Okay, I'll make a couple comments. So I'm not an expert in energy, so my confidence will be a lot less on this topic than on AI, where I do feel like I sort of understand the field a lot better. It's definitely the case that data centers, even though they are increasing the efficiency, so NVIDIA is big on high performance computing, which is basically with the same amount of energy getting 10 times the computation. And then, the next cycle comes and we want 10 times more with the same energy. So there is this awareness that energy is a limited resource. And because the demand for computational power is so high, it's absolutely correct that energy usage is going up and more of it is going towards AI. I was interviewed for University News and they asked me the same question about when are we going to run out of energy? And I said, gosh, that's a tough one. It is the case that that's a field that some people are investing in. The little bit that I know about it, it's more secondhand, but it would be, there's this idea of orphan power. So people are building data centers and some of the power, maybe it's wind power or hydroelectric, exists in a certain location, but they don't have the transmission lines built yet to ship it to other places. And so you have this excess capacity. And so that is a potential opportunity that made logical sense to me. I can't tell you specific companies. I don't know a lot about it, but from first principles, things like that make a lot of sense where you can find unused power. There's companies that will build data centers where there is unused power and take advantage of that, at least in the short term. I'm sure there's a lot of other plays that you can make on energy. It might be a way to diversify. Beyond that, I mean, you really have to do some research on it that would be beyond my knowledge.
And we're just about coming to an end. Prior to the private session, there is an opportunity for those that would like to ask a question, and I believe on LinkedIn and certain platforms, as we're live, you should be able to do that. I haven't figured out on StreamYard for the webinar participants, I think, how to do that, but some of you also have my text numbers. 1 or 2 of you have sent in a question, which I'll get to in a second. Any takeaway messages before we get to a final question or two from the audience that you want to leave us with in regards to AI investing and effectively the future of AI for humanity?
So I guess if I summarize the investing piece, I'd say just understanding those 3 pillars, that it's about computation, it's about the algorithms or the AI talent, and it's about the data, that if you use those as the lens for evaluating companies, that can take you a long way, in my opinion. And also, if there's one thesis that I personally believe in right now, it's that Wall Street hasn't priced in the speed at which things are going to move. And so for sophisticated investors, there's lots of strategies you can use. If you believe that thesis, there's ways that you can sort of invest to profit from that. And just a general point is, of course, you have to be very sensitive to your risk tolerance and be prepared for a lot of volatility. So without that being investment advice, that's my summary of how I'm personally investing and how I look at it. In terms of future of humanity, this is really serious. Tremendous opportunity, 80% chance this is the best thing ever. But there's very few technologies where you have almost every leader signing on to a statement saying this could be as dangerous as nuclear weapons or pandemics. And a lot of people, almost every serious AI researcher says there's a non-zero chance that it wipes out everybody. So, I mean, how often do you come up with a technology that could wipe out everybody? That's very rare. Even if the chance is very low, which I think it is, it needs to be taken seriously. And so from that perspective, I think the most important thing for designers at those tech companies and people in the field is to get off of this mode of trying to test in safety after the fact and begin thinking about how do we design the system to be safe from the beginning. And for all of us, just be aware that AI is going to be analyzing everything we do. We talked about how important data was. So every post, every email, every tweet that we all do, it's all going to go in there. And if we put our best foot forward, meaning we're acting in ethical and moral ways and setting that example, it will learn that. But if we put bad things out there, it will learn that too. So all of us have some responsibility in how we behave online. And the AI researchers have a huge responsibility to design this thing the right way.
Very good point. We'll get to that final question or two from the audience that said something in via text. As I'm wrapping up, I will add, besides the return of Dr. Kaplan from a year and a half ago, and it's been great, he's not the only Kaplan that has been interviewed on my platform before. Craig's dad, Melvin, who is a wonderful long-term, and I mean long-term, over 60-year real estate investor. I did an interview, I believe it was late October of the past year, so 2023. It is up under a past live. If you go to the live tab on my platform on Family Office TV or at Family Office, and interesting discussion. And I don't want to get too far off topic and very different than AI, but I could make a point that many of my families noted that to be contrarian now could actually be an interesting time, including in commercial real estate and including in areas like where your dad's based in the greater Bay Area in San Francisco. Now, that could be a subject of its own discussion for probably hours because I could probably argue either point. But it comes down to a little bit of what I mentioned earlier, supply and demand within a market infrastructure, and what price, what discount, what terms, arguably what influence politically, locally I would have to kind of make things happen and make it a viable purchase. But some of you may want to go back and listen to that interview with Melvin Kaplan. That was wonderful, and I really enjoyed that. I will now take a look at the question or two, a little bit off the beaten path. I believe it's a BlackRock algorithm called Aladian that it potentially moves markets, and I'm assuming would have an impact on tech or AI. Do you have any understanding of it or opinion about it?
So I don't know the details of that specific algorithm. In general, trading algorithms operate on relatively short time horizons. So things that can move prices over the course of days or even weeks is essentially noise from the perspective that I've been talking about, right? Because my thesis is it's extremely hard to compete on short-term trading with these guys. And maybe that algorithm is one reason. There's certainly plenty of other algorithms, even without that one, that would make it very, very dangerous for the average retail investor or the average personal investor, even the average family office with the resources that they have to try to compete on those short time horizons. If there's one thing I learned after 14 years of trying to do it, is how hard that is. On the other hand, if you take a longer term view, I think that essentially amounts to noise. You may have price movement short term. Maybe it pushes up the price. You don't get as good a price when you buy in because somebody's doing something. That's okay because you're taking a 3-year, 5-year time horizon and you're expecting things to double over that period. And you have a particular reason why you believe that short-term market dynamics. So if you're sticking to that, which is what I do, then you can sort of safely ignore that. But if you are trying to do short-term trading, then yeah, it's a very tough game and you need to know about all those things.
I'll allow a chance for Craig to say the final word, and also his company in terms of the work that they're doing, to have a chance to talk a little bit about that. Before I get there, and as we wrap up, first of all, thank all of you. A reminder, and Dr. Kaplan did mention it earlier, this is for information and entertainment purposes. It is early midsummer of 2024. You may hear this in a day, a month, a year, 10 years from now. It could be completely different. So timing does matter. At the end of the day, we all have different tolerances, different needs, different goals, and you need to effectively do your own form your own thesis, make your own decisions, aka think for yourself. And you always need to do diligence on investing. You just don't know. At the end of the day, you can not only lose money, in theory, you can lose all your money. So again, you need to think for yourself and make your own decision. For those of you yet that are a family or a family office that is not a founding member of SFO Continuity, I would ask, what are you waiting for? So some of you have heard my pitch and my programming dedicated to that subject. It's the summer of 2024. I am very, very active, not just with private digital, very informative programs, but with really a series of about 10 different programs in person, from breakfast, lunch, to soirees, to dinners, to private forums on 10xing your investments, on Unstoppable Heirs, on my series about survival of the family office, including my upcoming debate next week with Jamie McLaughlin, which I very much look forward to, and a variety of other proprietary content and resources and connections. People like Craig and others that are also successful families, and the interaction, not just digitally, but in person, and really the off the record conversations where we get really, really deep. Simply go to angelorobles.com, my website. You kind of can't miss it, but it's under the membership tab. It's kind of all over the place, and consider joining and being a part of an incredibly private and unique group dedicated to real investors and family offices, not to vendors, not to sponsors, not to providers. No offense, I'm sure they're awesome people and they could occasionally make a great guest speaker, but really the heart of the group is peer to peer and real intense, deep discussions and debates internally. On that note, Craig, I'm going to give the final floor to you for either and or a final comment, and to share a little bit of your contact info for those that would have an interest in learning more about your company, IQ Company. How could they learn more about you and the company, and final comments?
Sure. Okay. So on the company piece, you can go to iqco.com. IQ Company is my company. Or if it's easier to remember, you could type in superintelligence.com, which is very, just recently, Ilya Sutskever left OpenAI and founded a company called Safe Superintelligence. Well, we've been researching this since 2006 and own the domain name. So that's an area. And at the site, you'll find a lot about AI, a lot about AI safety, talks I've given at conferences on AI. So if you want to learn more about AI, there's one on the history, past, present, future of AI. There's a link to the video interview that Angelo and I did back in February. So you can find that there as well as on his site. So a lot of educational information, I would say, you could find there. And in terms of final comments, be diligent on your, risk and know your risk tolerance. Seek outside advice. Don't sort of just listen to one podcast and sort of plunge into something. So as Angelo said, that's just prudent. But in terms of AI investing, I think this is an opportunity like one I've never seen in my entire life. And I've been in technology for probably 35 years, lived through the .com bubble and all that kind of stuff, and have been a serial entrepreneur. I've never seen anything like this. It's really amazing. There's tremendous opportunity. There's also danger. And so paying attention to the AI safety aspect as well, I think, is something that all of us just have a responsibility to do, because it's not just us, but it's our kids and future generations. And it's really the actions that we take now that are going to have the effect. We have a limited window. There will be a point at which it doesn't really matter what humans do anymore, but right now it does. And so you and I and Angelo and everybody in this session really has a chance to make a difference. There's more information about that on the website as well. So thank you very much, Angelo, for inviting me to this.
My pleasure, Craig. It's a pleasure to have you on to share your insights with my audience. Look forward to today, for those live, the 5:30 private Zoom session for selectively some members that can make it. Some of them will get it in a private, or most of them actually in a private recording. But those of you that may be live at the moment, email me like right now at angelo@angelorobles.com, and I'll allow 3 special guests in terms of coming on. On that note, Dr. Kaplan, well, technically, you'll see me in a couple of more minutes. But on that note, time to say goodbye. I hope you all enjoyed it. Thank you all very much. And thank you, Dr. Kaplan. My pleasure.
Thank you, Angelo.